We're already in a very interesting year for the US dollar. So far this year, this is the worst start to a year for the US dollar this century, so for 25 years. There are a number of tailwinds for the US currency. Now, this is particularly interesting because if we look right back to the 1980s for emerging market equities, there's a very tight inverse correlation between emerging market equities and the US currency. So if we see the signs of a sustained decline in the US dollar, like we've seen at the start of this year, that bodes very well. That should be a strong tailwind for emerging market assets. Why should we expect the US dollar to continue to depreciate? The first is the US's unsustainable current account situation. So the current account deficit in the US is more than $1 trillion US dollars. And if we look at current account surplus countries around the world, it's pretty varied. It's a big mix. If we look at current account deficit, it's dominated by the US. US is 80% of global current account deficit. In the long run, economics suggests we shouldn't have these structural deficits or surplus. Currencies should adjust. What's happened with the US current account deficit is it's funded through portfolio flows. So we think about that. A deficit is a flow. It's $1 trillion, $1.1 trillion last year. That means every year we need to see, for the currency to stay flat, we need to see an equivalent inflow into US assets. And that's happened primarily through portfolio flows into equities and debt securities. Given what's happening with the current administration, given some changes to US exceptionalism, given the transition to, I think, a multipolar world, I think the outlook for this continued strong inflow into US assets is weaker. We're not saying that there's going to be an outflow or a collapse, just a slowing in that inflow into US dollar assets. And that means net-net, US dollar has to depreciate because we have to have that as the mechanism to balance the current and capital account. The second situation facing the US dollar is that unsustainable fiscal situation in the US. US has enormous public borrowings. And look, this administration is not making any headway on that. The Doge, don't believe the hype on Doge. The reality is if you look at mandatory spending and we add in military, which is effectively mandatory, and then we add in interest payments, already more than 3/4 of the budget is fixed, can't be cut. So US, it's not just a high level of debt, it's also a big deficit. And this new beautiful bill, this is going to add to the deficit situation. In that scenario, the US needs to have low real rates. It's the only possible way of sustaining this debt. Low real rates, all else being equal, weaker US dollar. And the final thing is we're very late already heading into this in a long US dollar bull market that was in place really since the GFC. And the US dollar looks extremely overvalued on a number of metrics. So I suspect this US dollar decline to continue, and I expect it to continue to be a tailwind for emerging market assets. And you certainly see that this year, Korean won, Mexican peso, Brazilian real, all strongly outperforming the US dollar. And that's, so in addition to the equity returns we're getting in those markets, we're getting a strong return from currency as well. So you get the double effect. And that, in the past, when we've seen this structural deterioration in US dollars, it's typically lasted for around 8 years on average since the early 70s. So we're looking at the beginning, potentially, of a very profound period of EM outperformance in this environment.